Hey everybody, welcome back. It's Friday, it's noon, which means the doctor will see you now. I am Seth Denson. It's good to have everybody back. I hope everybody had a wonderful Easter weekend this past weekend, wherever you celebrated. Hopefully you were surrounded by people that you love and love you, and you had a wonderful time. I'm excited about today's show, as I have been in each of the last shows that we've done, because what we've been trying to do is bring you relative topics that can help you through this craziness that sometimes we're living in. And obviously, a big thanks goes out to all of the guests that I've had so far. Dr. Rankins, who's been wonderful and brought really just great information, I think, to everybody. And then, of course, JJ, the CPA, who really helped us navigate part of the PPP and what was going on there, what businesses should do. A lot of moving parts there. And then, of course, last week we had Dr. Rankins back, and that went well also. Today, I'm particularly excited because not only do I get to spend some time with someone who I am a huge fan of and his work, and I consider to be my brother from another mother, but as we both say, but is someone who actually has a heart for people and wanting to help people. And I'm excited to bring on the show today Antonio Valente. Antonio, hey, buddy. How are you, man?
I'm doing great, my friend. I'm doing great. Thank you so much. Thanks.
You. So for those of you that don't know or maybe missed last week's show, Antonio helped kind of guide the show last week a little bit. He's a senior partner and a co-founder of the Penn Valente Group, which is part of Baird. Financial advising, wealth management, that's their forte. It's what they do. They're great at it. But listen, there's a lot of people that are really good at that. But there's not a lot of people, in my opinion, who do it to really improve the lives of their clients. And that's what Antonio and his group do. And even if it's not necessarily something that I've heard him give advice and counsel to people that doesn't necessarily put a dime in his pocket. And that just to me is someone who really cares about the betterment of others. And so, we're getting a lot of questions, and obviously a lot of people that are joining today's show. Some are business owners. Some, whether you're a business owner or not, are worried about maybe your own investment accounts and retirement accounts, or goodness, maybe even only your family budget. What should I do? What should I be spending money on? How long is this going to last? What is happening on Wall Street really, how does it impact me in my everyday life if I'm not in the market? And so we're going to get to the bottom of all that today. We're going to talk about all of it. I've got the Facebook chats and the YouTube chats up and running. So if you've got a specific question, feel free to reach out. But with that, Antonio, buddy.
Yeah.
What's going on in the markets today, man? I mean, yesterday it was announced, the president saying, hey, we're all going to go back to work soon. The economy is coming back. COVID is coming down. And I watched as the Dow futures hit 800. And man, it was a great day starting out. They're still up as of the time we started this, but they're sure not up 800.
Right.
This volatility in the market, what's going on, man?
Yeah, thank you. And I remember 4 weeks ago, I would be typing an email to a client about the state of the markets or even a particular company. And as I was typing it, it was already dated. Okay. Like it was already no longer happening. Like I would say the stock's at 85, we were already at 72. Right. And things are sort of stabilized over the last month. But what I think what we're going to see here is a lot of volatility because there's a lot of uncertainty right now in this market, Seth. And so we can get one headline at 12:01 that says we're going to open the economy back up. And, by 12:05, we're getting another headline that says, how can you possibly do that? And so folks are going guardrail to guardrail out there on sort of an emotional roller coaster. And the market, unfortunately, is part of that process. And that's really what we're experiencing right now.
So if what should we be doing, right? Short term, long term, right? We have to kind of play both sides of the coin.
Absolutely.
And likely there's people that are tuning in that may be trying to be or hopefully closer to where they would be when they are going to retire. Others that are saying, hey, I got a long way off. I'm hearing that stocks are on sale. What do I do? Maybe break that down for us from a short term perspective to a long term perspective. What should somebody be doing?
Yeah. Great question, Seth. And I think the answer to that really is a factor of a couple different things. Is one, if we're talking about retirement monies, how close are you to retirement? So somebody in their 20s and 30s right now has 30 to 40 years to go before they actually get to retirement age. And so this short-term volatility really shouldn't do much for them in terms of their retirement planning. Now, if you're in your 40s or 50s, it has a little bit more of an impact, but not as much as, let's say, if you're in your 60s. The most important thing that we always advise our clients is you have to learn how to tune out the noise, okay? You don't want the media, you don't want the noise to dictate your own financial plan, okay? And so when you take a step back and you tune out the noise, you have hopefully a better allocation that's really appropriate to you. That's the most important thing, because we cannot control what we do not know. And so we're helping folks, Seth, really control what they can control, which is the amount of risk that they are taking on, whether we're talking about short-term money, something that you're going to use, let's say, within a year, or something intermediate between, let's call it 2 to 5 years. And we would just start thinking about long-term investing, anything that's 5 years and beyond.
Okay. So, with all this market volatility, I mean,
Yeah.
Is there an end in sight to it? What are you thinking is out there? Where do you think have we hit the ball moving back up? Are we going to go back down? What do you think?
Well, let me answer that first part. So in terms of volatility, there's always going to be volatility in the market. Okay. There's no getting away from that. And funny enough is that a lot of folks, when I'm speaking to them for the first time, they come to me and they're saying volatility is directional. And they think of volatility only in terms of downside market. And that's actually not true. Okay, so in 2019, the S&P was up over 30%. We consider that upside volatility. Okay, so we look at the longer term averages to sort of give us a breadth of, well, what's realistic, what's sustainable, and what is not. And so up 30% and down 30%, right, are not sustainable. But in terms of right now, because these really are unprecedented times, we don't really think right now that this volatility is over. And we're in earnings season right now, so companies are starting to tell us what they're seeing in terms of their own business models and how they're projecting forward. And one of the biggest things that we keep hearing about is a lack of visibility. Okay, so companies can't really see beyond the next 6 days, 7 days, and that gives us a little bit of caution. We might not test the exact lows that we saw in March, but I certainly wouldn't say that we're out of the woods right now.
So what do you expect as you think about these companies that are prepping their earnings reports, this first go round, so to speak, since all this has occurred? What do you expect to see maybe this earnings report and I'll ask you to maybe even stretch that, and I know that there's no crystal ball here, but what are you projecting or maybe expecting to see in the next one?
Yeah. So I think we're going to hear a lot of folks again say that they're lacking visibility. And I think for most companies out there, this is really going to be led by the health side of this equation, right? And so until the economy really opens up, you have to take a look back at, certain companies are going to be impacted, obviously more airlines, right? Cruise lines, those companies are really impacted. And until folks start flying again, until, folks start sailing again, they're going to have a really, really tough time to make any sort of profit or even have any kind of revenue. You've got other companies that are really, let's call it the part of the in-home technology, and well, they're actually doing just fine. So you're going to hear companies based on what they're doing, either explain or show that they're going to have a tough time, at least over the next quarter here, and then other companies are not going to be impacted as much. The big kicker here of what's going to happen is, when are we going to reopen the economy? What is that going to look like? And are folks just going to go back to normal? I think our new normal is going to look a little bit different than before all this happened, Seth.
Yeah, I agree. I agree. I tend to think, at least my own opinion has been on this, that there is somewhat of a line of demarcation, right? That the economy in general was in a really good position before we went into this, arguably one of the best positions we've ever been in.
Yeah.
And that unlike maybe '08 or even the Great Depression or some of these other things that we can kind of look back at, or, the crash of the '80s, this wasn't done. We're shutting the economy down,
Yeah.
and that the fundamentals though prior to that were so strong though, and thank goodness we'd seen the markets do what they had done in the time before that it would bounce back quickly. I think even Goldman Sachs this past week put out a report that they are projecting it to be much more of a V type bounce back, right? Where as quickly as it went down, it could go back up. But to me, that is based on a time period, right? And in
That's right.
my thought, I got to think that that's got to be somewhere in or around May 15th. That if we don't have at least a large part of the economy back up and running by May 15th, that the likelihood of that V is very low. What are your thoughts?
Oh, I agree with you 100%. Actually, you said something that was really, really powerful. So, back in 2008 and 2009, the policy was a little bit delayed in providing, support into the credit markets and into companies as well. And that actually caused, the recovery to be extended out further. But like as you said, that 2008, 2009 crisis was really a financial crisis that created all the problems. And this one here is not. I'm going to tell you this, is that in my personal belief is that if 2008, 2009 did not happen, and we did not have the playbook of how to structure certain policies and support like CARES Act, right, to really help out companies and individuals, I think we'd already be in a depression right now. It might not look like the one from, the 20s and the 30s and, a 12-year span, but we probably would be in an 18-month to 24-month depression right now. So a lot of concern there.
Yeah. So in thinking through that, I mean, not telling people they shouldn't just go out and hire you because they should, but when
Yeah.
you're talking to your clients right now and recognizing where each of them may be in their own portfolio,
Right.
take somebody who maybe has some cash sitting on the sidelines. They were waiting for some type of, we'll call it bear market, and I'm going to come back to that because I had a question on bear markets.
Sure.
But are you advising them, hey, for many of you, stocks might be on sale right now, and so go in the classic kind of buy low, sell high world. Is this an opportunity for some?
Yeah, it is. It is. I mean, so depending on, an individual, hopefully they're not impacted, first of all, that they and their loved ones are fine with this, with this virus, and hopefully they're still employed. Well, there's some great opportunities here for taking a little bit of a longer term approach. We've always been a quality shop. We don't really like companies that are just barely getting by. We understand the incubation period of a small company and what that looks like. And sometimes what you're buying are future earnings because a company's got an incredible drug pipeline or perhaps incredible technology. But this here is really a market about quality. In fact, I'll say it 3 times: quality, quality, quality. Okay. And you want companies, you want names that have been around for 100 years. I think of a company like Coca-Cola, and I don't drink Coca-Cola, but I think about a company like them, and they've been through world wars. So do I feel like they're going to be, living past coronavirus? Well, absolutely I do. I don't have any concerns there. There are a lot of companies in the S&P 500 that I'm not as sure of.
Interesting. So from a perspective of it,
Yeah.
right? Let's walk through maybe the historical aspects of a bear market and maybe projections of today's bear market, which kind of ties back into the question I had earlier.
Yeah.
How long does a typical bear market last?
Yeah. So great question. So bear market is just first. Let me define that as a 20% drop right from where we were. And at the market lows here, we hit about 32.5%. Let's call that the third week of March. So we were well within a bear market. Bear markets typically last a year. Okay, so if you can go back and, my 23-year career, I remember helping folks through the dot-com bear market, even obviously the 2008, 2009 bear market. If you can get a chart and look through, what the S&P has done or what the Dow did during that time period, you will find over a longer period, let's call it 6 months or, 8 months, you will see that those indexes actually increased and dropped again. Okay, so we might be like 2 months from now, we might be down another 10 or 15%, and we could be in a little bit of a longer type of bear market. Again, I've never seen a bear market last 4 weeks, and so I know we're up off of the lows right here. I'm just not really 100% comfortable to say that this bear market is done. We got 22 million folks in the last 4 weeks that have gone unemployment. That's a big problem.
Yeah, so a lot of talk before we even had this pandemic and we saw what the markets do what they do, that we had to be nearing the end of the bull market rally that we had seen. And that, as a matter of fact, I think that, depending on the analyst or maybe even the media network you tend to get your information from, it was almost like some of them were looking for something to be the sign, whether that be the inverted yield curve, right, or some of these other things that were going on in the bond markets. So are you of the opinion that, we were nearing the end of that bull rally anyway? So and again, I don't want to put words in your mouth. And what I'm hearing you saying is the compounded impact of the pandemic, on top of the fact that we were probably near the top anyway, may prove itself to be an extended bear market for some period of time.
Yeah, so, we have follow a process here, and obviously tuning out noise is one of the biggest ones, but that's really helping folks understand their asset allocation. What really drives us is we look at different indicators like the bond market and things like this. But when I hear investor sentiment after a year like 2019, where everything went up, and folks start to remind me of what it was like back during the 2000 or 1999, where they feel like they're all little Warren Buffetts out there making stock picks, that gives me a lot of concern. Because as I said earlier, that volatility, it's not the volatility that hurts, it's the volatility that feels good. So when the S&P is up 31% and every company's priced to perfection, we like to take a step back. In fact, I'm not telling you that we thought coronavirus was going to do what it did, but our first communication to our clients in January, which is the first week in January, was it's time to rebalance portfolios. It's time to have those conversations. The stocks were up strongly in 2019. This is our opportunity to rebalance the portfolios and make sure everyone's time horizon and risk profile is still intact.
So kind of getting right in, I'm in my 20s.
Yeah.
Should I be pulling money out of the market or putting money into the market?
Yeah, so I'm going to assume that Nathan's fully employed and still working and contributing into a 401k and something to that effect. And in that case, I'm going to say, absolutely, this should not change your long-term provisions. The funny thing about bear markets is, they all do two things. They all make, especially bear markets with a recession as well, okay, is that they all feel like it's going to be the end of the world, right? And it certainly felt that way back in 2008 and 2009, and it felt that way. Gosh, it could even feel that way right now, but it certainly felt that way 3 weeks ago. The other thing that every single bear market has always done, Seth, is that it's created the pathway for a new bull market, which has led to new all-time highs. And so this was going to be no different than that as well.
So to Nathan, fully employed, you would recommend first, obviously, put as much as you can in 401ks, right? Because assuming that there's some type of match or opportunity there.
That's right.
But then secondarily is, take advantage.
Absolutely. If your outlook is 40 years down the road, what's happening today should not derail you from that.
Beautiful. So let's talk 401ks. Because a lot of business owners that may be tuning into this.
Sure.
And for those that are maybe challenged with where do I start to look at expenses to cut? Maybe I'm getting PPP money. Maybe I'm not getting PPP money. And by the way, I'll just kind of a little shout out to Joshua Jens, who I know has joined the program at times. If you're not listening to him, if you're not subscribed to him on YouTube, go. He's got great content he's putting out day in and day out on this. So if you're a business owner and you're not subscribed to JJ, the CPA's YouTube page, go do that. You'll be doing yourself a favor. But where should I be maybe looking to make cuts? If I'm an employer and I'm strapped, should I be pulling back on maybe doing employer matches? You manage a lot of 401k plans. What are you telling the employers that you represent?
Yeah. So it sort of depends, right? Every company's a little bit different, but we're going to say, just like we would for an individual investor, that quality is the most important factor in this process, and that is doubly true in terms of 401k and institutional management. And so we've always recommended that plan designs be supportive of these types of systemic shocks because, again, we can't predict when something like this is going to happen, right? And so we're a big fan of discretionary matching. We're a big fan of helping employers communicate a message to their employees. For most individuals in America, 401k is the number one way that they save for retirement. So it's really critically important. I would tell you that most employees, when they get a communication that's properly communicated to them with an education platform that helps them understand the longer term impacts of things like investing in 401k and match, most of them would be okay to lower the match or even suspend a match for a shorter period of time if that money is going to help the company survive and allow things to get back to normal.
So the key there then is what you're saying is communicate, right? If
Yeah.
you're an employer and you need to be making decisions, make sure you're communicating so your employees are understanding and on board with it. Maybe they don't like it, but at least they'll understand the sentiment behind it rather it being just, hey, we must do this.
You're exactly right. So I've yet to see a piece of legislation, or even if I took 100 folks and said everyone's getting vanilla ice cream, my guess is 85 people are going to like it and some people don't like vanilla. Right. So even if I'm giving out free ice cream, I'm going to upset some folks. And so, when I take that into the real world and say, well, okay, now we have to, cut back match for a little bit, the majority of the folks are going to really understand it. If it's communicated properly, we're working close with plan sponsors. There's so much that, that a human resource manager is dealing with, right? This is just one small part of their pie. So we, work with plan sponsors, say your team needs to be excellent, and it needs to go beyond the scope of just like, your internal folks. But who's your advisor? What are they doing? Are they accessible to your employees? Are they taking proactive phone calls? Is it everything reactive? Right? All those different things. And then one thing I'll say, and if it's okay for me to say, like your organization, GDP Advisors, right, is we're always working. So 401k, if you would look at what's the employer benefit expenses, 401k is actually a small piece of the pie, and health equation is huge. And so we've always enjoyed working with you, Seth, for this very reason, is because we're helping plan sponsors solve all their benefit problems, right? So if we can lower the costs in terms of healthcare management, okay, that's going to free up a lot of other employer resources to put a best of breed policy into everything that they're doing. The goal of a 401k plan is to help employees retire. That's the goal. If that plan and the folks that are working to support the 401k plan are not effective in helping companies achieve that goal, that company has a far greater problem.
That's a good point. That's likewise the reason we enjoy working with you as well.
Thank you.
You've obviously read through the CARES Act. You made mention of
Sure.
policy specifics there.
Yeah.
What is your thoughts? I mean, the CARES Act really didn't address 401k plans, did it? I mean, and what are your thoughts on the whole CARES Act and what that provided or didn't provide?
Yeah. So, I'll tell you this. So all the policies that have been, that have sort of been passed, if you take, and I think the total number is like 8 trillion or just shy of 8 trillion right now. If you took a dollar bill and stacked them up, okay, it would go to the moon and all the way back. That is how much money, that is how much stimulus between monetary policy and fiscal policy has been thrown into this equation. And Seth, that's in 4 weeks. Okay. And my guess is that they're not done. I'm already hearing in Washington and some folks that are talking about a next level phase that's going to go directly a little bit more support to individuals. And I think that's needed right now. But the CARES Act in terms of 401k really didn't, I don't know what the CARES Act could have really done more than what they did here. And I think the goal of the CARES Act in terms of 401k was to help individuals solve this short-term problem. And so they loosened some restrictions in terms of taking distributions from 401ks and IRAs. They lowered early withdrawal tax penalties if you're under age 59 and a half previously. So up to $100,000, individuals can take a distribution from a 401k or an IRA right now and waive that 10% early withdrawal tax penalty if you're qualified to take that distribution. So you have to meet certain criteria, Seth, in order to take one of these CARES Act, let's say, distributions or some type of favorable loan policy. My biggest concern, and I know what policy was trying to do, was we need to help folks, and this is our way of doing it. And I'm all for that. Like you said in the intro, I mean, we believe that every person, regardless of their income, deserves the right to retire with dignity. And we work our butts off to make sure that folks get that. My concern with some of these distributions and some of these loans is that they may solve a short-term problem, but create a longer-term problem for the investor.
Interesting. So do you think, let's think post COVID-19, do you think this will change fundamentally the way that maybe we treat 401ks or approach 401ks, whether that be legislatively or just in practicality?
No. I think you're going to see more dependence on 401k, because if you were saving, right, and building your wealth, right, is a function of two things. It's you have to save and you have to control your spending. And most folks in America look at saving after they've done all their spending. And we try to help our, let's say, 401k participants and our clients understand that savings is a function like your mortgage. If you treat savings like you treat your mortgage, you're basically going to be living off of 70 to 80% of your income. You are going to hit all your retirement goals. You will also have the funds to build an emergency reserve, right? This should be short-term money, cash to, you lose your job right now. You don't want to immediately go and debit your retirement money, but you can use that cash that you've been saving along the process. So I think what we're going to see is post-COVID-19 is more IRA use, more, financial education to help folks get to where they want to go, both short-term and long-term.
So, financial trade-offs, they really become apparent in tough times.
Yeah.
Right. I mean, that's just the reality of things. If I'm furloughed or if I've lost my job, how does somebody balance, investing, not investing, obviously, hunkering down? What are you recommending to people to make sure that they're focusing on right now?
Yeah. So let's take a case of an individual who was working, they were saving, through 401k or an IRA or a SEP, whatever it is, and then all of a sudden income is slowed down, right? It's hard to save for retirement if there's no income coming in. So I'm probably going to say in this short-term basis right now, it's going to be okay to take the foot off the gas pedal there in terms of retirement savings. What I'm hoping is that this individual in this example here has been doing a pretty good job of putting away some short-term money for, let's call it, emergency cash reserves. We think it's a great idea to have at least 3 months, okay, of your daily expenses, okay, of your monthly expenses saved. That should be sitting in cash. And so when something like this comes, somebody's got a little bit of a breather room to solve some short-term problems. So that is probably really where I think a lot of individuals are. If somebody was not doing any of these things here, then what you're looking at is, how do I pay bills, right? And that's sort of a different equation. Now, I know part of this policy, part of what Washington's trying to do is to allow a lot of forbearance, a little bit of breathing room for individuals to, let's say, I can't make my mortgage payment this month. Well, hopefully, we don't know the timetable yet, but hopefully we're going back to work, within the next couple of weeks, or maybe it's in the next month, right? So, folks can maybe kick down a payment, 1 month, 2 months. Credit card companies, I know as well, from what I understand from what we're reading, and also from what we're hearing from folks, is that they're doing that as well. They're saying, it's not going to impact your credit. It's not going to do these things. You're able to kick things off. We want individuals to focus on the most critical needs. I mean, really at this point right now, it's putting food on the table. Where hopefully that stimulus check that's exactly what it's doing.
So how do you recommend from a person, let's say they don't have that emergency fund set up, that 3 months set aside, how do you get started doing that? And obviously it's tough to get started right now, especially if you've been furloughed or laid off, you don't have income coming in, but let's fast forward. Maybe I've got a job and I need to do that. What do you recommend to people to start doing just that?
Yeah. So when I'm talking to when we're doing 401k education, there's a joke that I tell folks, and I say, look, I'm not here to make any promises, but my one promise, there's one that I make, Seth, and is that if you save nothing, you will find nothing. That is what you will find. Okay. So when folks really understand that, Seth, they come to the understanding that saving 1% of your income is infinitely better than saving 0%. And most folks can find that they're able to save at least 1%. And when we talk to folks and we're helping individuals getting out of not saving anything at all to going to just 1%, most of those individuals within 6 months are telling us, hey, I can do more. And within a year, almost 90% of those individuals are saying, we can definitely do more, and they're going to 2 to 3%. We can slowly help individuals, right, get to a more effective savings rate. The effective savings rate really needs to be 10 to 15%. That's all sources. You're getting a match, profit sharing, whatever those things are. We're trying to help folks get to at least 10% of their income.
Excellent. So, we talk all walk run methodology, and it sounds like kind of that's what you're establishing there. If you're not doing something, you're not saving anything, start saving something, right? 1%, right? Then you can get to the position where maybe you're saving 5%, 10%, and even more going forward.
Exactly. So the U.S. average income, I want to say, is, let's call it $50,000. If somebody was saving 1%, that's $500 a year. You start breaking that up and what that means on a monthly basis, and that's like a cup of coffees, right? I mean, that's really where we're getting at, right? So small changes over time have enormous impacts, and they're usually positive impacts.
Right. Yeah. Maybe a couple of basic coffees. Starbucks. Right. But, there's one Starbucks a month, right?
Well said. Well said.
Well, all right. So let's talk about maybe controlling debt then, because I think those part and parcel have to kind of come together. And then we are a nation of debt. Yes. What do you advise people that are saying, hey, I'm having trouble in this debt arena? How do they control that?
Yeah, so I mean, I'll tell you this, there's good debt and there's bad debt, right? So a good debt is typically your house, right? That's an asset, that's an appreciating asset. And so when we're building a financial plan for our clients, those are good debts to have, right? There's usually have some tax favorability to them, but the way we look at it is that you are paying for an asset that we hope and should, based on history, right, increase in value. And there's the bad debt. Okay. And that is, buying a brand new car is not necessarily an appreciating asset. Okay. I'm in my 40s. I've never bought a brand new car in my life, and I can't do what I do and actually probably ever consciously say, okay, I'm going to go buy a brand new car. It's not that I don't have the money to do it, it's that I choose to do my spending a little bit differently, okay? And so we have these conversations about how to manage debt. And again, as I said a minute ago, small changes over time really create large positive consequences. If if all our viewers right here take savings, and I said savings, set a goal to save 10%, and put that, right, like take a balance sheet, your family income, start listing your expenses, mortgage, car, gas, electricity, right? You start put savings right there. If you put savings there, you will be saving, right? It's part of your process. Treat it like your mortgage, and you'll be living off of 80% of your income. You're already doing it. You will be solving your problem just because you are met right up front because you're handling the income side of that equation.
So you mentioned the housing market, or at least houses. When is a good time? Maybe what is the estimated impact of all this on the housing market? Are you seeing anything? And when should someone maybe be considering, hey, I should probably refi, or maybe this is the time to get out of renting a house, and now I should buy a house?
Right. So I'll take the first part of that first, Seth. And so, rates are low. It's hard to see how they can go any lower. If we go any lower, we got negative rates, and that's a whole different type of problem. So I feel pretty comfortable that and rates have actually stabilized, in the housing market now over the last couple of weeks. But if you're going to stay inside that home for a good while, and not just be out of it in the next year, then it probably does make some sense to take a look at refining, based on where your current interest rate is, if it does make mathematical sense. And for most folks, it does right now. if you are renting right now, this could be an excellent time to buy a house. The only caution I think I'd throw in, conversation we would have with our clients are you working right now? And how comfortable do you feel in terms of visibility of the income that you have? We just saw a report come out this week that JP Morgan's making the lending standards for housing a little bit more difficult. I expect a lot more banks and housing institutions are lending to do that, Seth. And so if an individual does not have that visibility about where they're going to be, we don't want folks to take on a big debt and then not have the income to support it.
Excellent. That's a good thought. I haven't thought about that. So what are some hot sectors of the market right now then, right? We've talked about the housing market. We've talked about kind of some of those maybe fundamental, we'll call them large cap stocks that are out there that people have, that have sustained world wars, right? You mentioned Coca-Cola.
That's right.
But, what are some hot things right now that if I've got some cash, man, I should maybe look into this?
Yeah. So, a question I get a lot from folks, and I think, we saw one that came through, said like, airlines now, or folks are never going to fly again. And, I remember going to work on September 11th, that Tuesday. I remember that I was driving in early. It was 6:30. Nothing had happened yet. And, by 2 o'clock, folks were saying they were never going to fly again. And that's not what happened. It just changed the way we flew, right? We started going through TSA, there was all this, and then somebody, tried to do a shoe bomb, so then we had to start taking our shoes off. My guess is, look, we're going to still fly around the country. That process might be a little bit different. Maybe we're getting those, temperature zaps, something that before we're getting on, right? So something to that effect. So I don't think in terms of draconian changes coming out of this, we're still going to fly. Businesses may operate travel a little bit differently. I feel more comfortable to say folks are going to take a much needed vacation after this process. That seems a lot more likely than, say, businesses doing, all these on-site. So how business is done is an interesting sector, right? So the technology that is supporting these types of communications that we're doing right now, right? And the things that are making this type of communication work is a really interesting sector.
Yeah. So you mentioned the people and I remember after September 11th too, a lot of people saying they would or wouldn't never do anything. And, lo and behold, fast forward what is now almost 20 years later. And, I fly all the time and I've been on airplanes and most of them are always crammed. Matter of fact, airlines are finding new ways to add more seats. I think eventually we're all going to be sitting in the cargo hold. But nonetheless, it is that initial commentary, I think, that a lot of times people focus on. So let's maybe shift gears, and I'm just going to ask you about social media. Right.
Yeah.
So social media right now, obviously we're on one of those platforms right now.
Yeah.
Is it helpful or hurtful in this? I mean, you've got a lot of Monday morning quarterbacks or people that maybe their crystal ball they think is clear. What are your thoughts there?
Yeah. That's a great point. So, so there are a lot of good aspects, much with life, right? There's a lot of great aspects with social media. It's a great way to stay connected to folks. It's a great way to communicate, a positive and healthy message. And I always tell, we tell our clients, and I get a lot of these calls from folks as, hey, this person's really good at, making pizzas and picking stocks. And they really like this one name over here. And we always add a lot of caution. In fact, what research has shown, like if you go onto like a stock web forum or a stock chat group and individuals are talking about stocks, what research has shown is that these are individuals that own certain shares of whatever company that they're talking about, Seth, and they have this idea that, if they help promote whatever investment that they're in, that is going to actually help them, right? So we take a step back and say, when somebody is talking about whatever it is that they're talking about, take a step back and understand where they're coming from. Unless, of course, they're a professional. Like they say, the purpose of life is to live a life of purpose. And this is my purpose, right? This doesn't feel like work to me. Helping folks get to where they want to go to life is why I wake up every morning and do what I do. And so, me talking about something probably makes a lot more sense. An advisor talking about something probably makes a lot more sense than what you're going to see in here in terms of social media. I got a lot of concerns about suitability, things of those natures, and proper risk management in social media.
So we covered a lot of stuff, right? Savings. We've covered, a lot of things that are going on out there, markets and bulls and bears. What have we not covered? If you got a captive audience and you're trying to deliver one message from the great Antonio Valente, what is it that you would tell people right now?
Yeah, I always say this, right, is just stay calm, right? Like we need to stay grounded, right? So we don't build plans for the next 90 minutes. We don't build them for the next 90 days. We build them for long periods of time, right? And we're professionally trying to figure out where somebody is and help them to go where they want to go. And we want to do that, Seth, with the least amount of volatility that we possibly can. So we're always okay to give up some upside if we can protect downside, right? It hurts twice as much to lose money than it does to feel great about winning a little bit of money. So we're really cognizant of that. The world is going to go on. We are not, like I jokingly said once with a client, and I said, what's the worst case scenario of coronavirus? And he said, we all get it. And I said, if we all get it, what happens, Seth? And he said, well, we all die. And I'm like, well, none of this matters anymore, right? If we all die, then none of this matters. But I'm here to tell you that I don't believe that's going to happen. It doesn't look like that's going to happen. I'm sure it felt that way during World War II. I'm sure it felt that way during World War I. You know what? It felt that way during 2008, 2009. It felt that way after 9/11, okay? And it feels like that right now, Seth. We really want folks to understand that life is going to go on. We will get through this, okay? And there will be a better tomorrow than we have right now.
That's a great message, man. I appreciate you giving that. So where do people find you, right? I mean, you guys do such great work. I want the world to know about you. Where do people find you if they want to get in touch with you?
Yeah, so I have a partner in Baltimore and then my office here in Dallas, but we've got clients all over the country. So we operate as a fiduciary. That's really important for clients. It means we're legally bound to do what's in their best interest. And I just say, the easiest thing is, pick up the phone, give me a call, right? Send me an email. Our number is 214-373-2925. That's direct to me. That's the way we operate our business. We don't want you talking to just whatever. You call us, you're talking to me, right? You'll talk to Brian, who's the other senior partner of the firm, of our team here. So that's an easy way. I'm on all sorts of LinkedIn and here as well. So folks can send me a message or send me an email as well.
Excellent. Thanks, buddy. And man, thank you for being on. I think that, what we need right now is calming voices like yours in the marketplace and not the noise that maybe we hear on cable news or even social media or some of these other outlets where people may or may not have, some unintended things that they're doing out there. So I appreciate your calmness and your measured response here and your wisdom. So thanks. And hopefully you'll come back and we can do this again very soon. I've got a dozen other questions I'd love to ask. So
absolutely. Listen, Seth, you're a great friend. You said it best. You're a brother from another mother is what we always say. And, iron sharpens iron. So this has been a great opportunity. I'm hoping that what we talked about here today is going to help a lot of folks get through the next short-term period. I want them to know that the longer-term period is going to be a lot better than it is today. And, I'm happy to be back here and anytime you like.
Thanks, buddy.
Absolutely.
So that's going to wrap another episode of The Doctor. We'll see you now, the Investment Doctor. So if you do have questions, please reach out to Antonio directly as the Investment Doctor. Let him help you out and guide you and your family or your company through that. Next week, I'm excited about next week. We have a former senior Trump administration official going to join us to talk about policy in Washington, D.C. What's coming? Are we going to get another CARES Act? Are we going to get more of that stimulus money? Maybe we'll lap the moon once again, as Antonio put it. We'll learn more. So Siri Kim is going to be joining us this upcoming Friday for another edition of The Doctor. We'll see you now. We'll talk about the latest out of Washington. Where is the Trump administration in all of this? What is coming? How is this going to impact things going forward? So please, set your calendars to tune in next Friday as Siri joins us. We're excited to have her. Have a great weekend. Thank you all. Thanks to Andrew Clark and the team at GDP Advisors for putting this on. And we'll look forward to talking to you all very, very soon. Be well.
Take care, everyone.